as we wait for US CPI data to give us a bit more of a clue on what is the main story in these financial markets really for the past 3 months, and one might argue the past 3 years, which is, of course, where will the Fed take interest rates and the global cost of money? We have something else to contend with, and that is, what is the reason that the Fed is expected to cut rates and most central banks in tandem? That is, where's growth going? Is it by accident that the Fed and other central banks now want to cut? Is it because the inflation story is just over, but everything else is fine? Well, not quite. There seems to be an acute concern, at least looking at the data, that a global recession is now becoming increasingly inescapable. And the question might well be brought back to the forefront for financial markets as data from the world's second largest economy, I am of course talking about China, is going to pepper the economic calendar all week long. So what we're going to do here is we're going to have a look at what that data is, what's coming out, and why what could happen here might inspire the return of growth concerns across financial markets and what that might mean in the context of everything else that's going on. So let's begin here, first and foremost, with a bit of stage setting. This is, of course, Macro Money. I'm Ilya Spivak, head of Global Macro. And over the next 30 minutes here, we're going to unpack this whole story and see if we can land on a tradable narrative to come out of it from the major asset classes, be they stocks, currencies, so forth. So on to stage setting. This is an index from Citigroup. It measures economic data surprises, so how economic data performs relative to forecasts. And the main upshot here is that for China, this index is now sitting at just about zero. That, of course, means that forecasts and realized results have essentially converged. Now, what this means is that as we look at the economic data that we are going to be considering here, we will find, or at least we are more likely to find, outcomes that hew closer to consensus forecasts and generally mirror what analysts have on their bingo card, that essentially we're probably not going to deviate very much. At least this is the current setting of things. Now, of course, surprises occur. This is by no means a guarantee. We get this kind of a situation until we don't. We can see that back in sort of the middle to second half of 2022, there was quite a bit of jostling around that middle line until, of course, from about the beginning of 2023, we had the reopening narrative give us better data than expected as you can see the index soared here, and then very quickly by mid-April, the tide was turning. People's expectations turned out to be too rosy, and data started to look abysmal relative to those rosy forecasts. It has since declined. Starting from about mid-July of last year, 2023, we started to get aggressive marking down of Chinese growth expectations. And so data outcomes started to moderate a little bit. They started to have an easier time beating forecasts. And that's how we arrive where we are now, where it seems like analyst models and the real economy are pretty well in line. So with this in mind, we are going to consider incoming outcomes as something that's probably going to hew closer to consensus forecasts, and then see, okay, if they do, then what does that mean? Let's begin then with the first batch of economic data that we are going to be looking at, and that's lending data. Now, you can see here essentially that what this is a kind of volatile sideways range. This is new loans. So how many new loans did we get in December? The last number that you see on the screen here, 1.09 trillion yuan, which, as you can surely tell here, is a little bit of an increase from the prior month, but generally on the lower end of where this clusters. For me, the more interesting number is the year on year for that range. And if we look at the expectations here, we're expected to go up from that 1.09 to about 1.23 trillion yuan. So looking on the chart here, 1.23 would land us somewhere in here. So a little bit of a pickup. And with that, we would get what would look like perhaps a little bit of a swing higher in the year-on-year numbers if we consider where we were in December of the prior year, which is, of course, the reference point for this. We can see here is January of 2022. That's the reference point here a year back, and then we push forward here. Here is the reference point for December of 2022, and then that would be the comparison for the year on year. You can see it's maybe a little bit higher than 1.2, but very, very close to sort of the lower half of the 1 to 2 trillion range. So if we get an outcome somewhere in here relative to the preceding numbers here a year before, we might get this year-on-year curve moving a touch lower, a touch higher, but doesn't look like there's going to be a meaningful shift in the trend. Similarly, if we look at just overall financing, this is not just new loans, this is all outstanding borrowing. Here, despite the increase in new loans, we're actually expecting to see a little bit of a pull backward. So the November number, 2.5 trillion yuan, this one expected at about 1.3. So a climb down, as it were. Not a dramatic one, but a climb down. What's interesting here in particular is we, of course, would see that again in year-on-year terms as something of a bounce. Because if we go back to what December looked like of 2022, which would be the reference point for this, we would be measuring a year-on-year change from here to, let's say, about here. And that would give us, on net, an increase. If we do the math on it, it would be an increase of about 69% year-on-year, which sounds huge. But when we consider the kind of swings that this thing has routinely and say, well, here is a swing of over 100%, here's a swing of over 100%, here's a swing of over 100%, here are swings of nearly 50% on the downside, this is a very volatile series. So it's probably not anything that's going to materially change the backdrop. And of course, the implication would be that you're not exactly seeing an upswell, a grand increase in borrowing, which of course means that while the monetary authorities have done a few things here and there to try to generate a pickup in China's anemic economy, it's not really a full-hearted effort. It's not really like what we saw with the monetary expansion in the Western economies as a response to COVID. We're not seeing that kind of a big splash effort here to really get the economy off the ground. And arguably that makes sense because, of course, the problems that we have in China are mainly about loss of export demand. And you can't really do much about that with more monetary largesse. So it seems like what these numbers speak to is that we're going to continue to kind of spin our wheels here as far as lending, and there's nothing particularly stimulative in these numbers that jumps out because, say, the central bank is ramping up support or is at least trying to create enough liquidity to offset, perhaps domestically, weakness on the external front. And speaking of the external front, that's the other piece of data that we get this week following on from the lending numbers. And here you can see this story of anemic demand. You can see both imports and exports year on year have been trending lower and in fact are now just hugging the zero line. So all of it has been essentially a downtrend undisturbed by reopening from COVID. You get a little bit of a pickup in exports in the first half of last year as you get some of these COVID lockdown restrictions removed starting in December of 2022. China's economy reopens, it starts to ship more things. So in year-on-year terms, it would make sense that you would get a bit of a pickup. Obviously, you can see here's the start of 2023, here's the start of 2022, where things still are falling and slowing. So this makes sense, but the trend lower, unbroken, and the situation now looking still very much like something that speaks to weakness both in demand externally and internally. The external picture does have something of a rosier set of expectations. Exports expected to rise 0.9% year on year after increasing 0.5% in November. Domestic demand, though, still expected to carry a negative sign. The import year on year number seen at down 0.5%. That's a little bit better, I suppose, than the down 0.6% number from November, but ever so slightly. And of course, suggests that we still have weakness here. And that, of course, in turn speaks to weakness in export demand as well, because there's a bit of a feedback loop here. Much of what China imports isn't for domestic consumption. China is the quintessential, for now anyway, the quintessential hub at the center of the global supply chain for value add work. So raw and semi-finished goods come in, labor is applied, they become finished or more finished goods and leave. So a lot of what is imported is actually the building blocks for what will be ultimately exported. So yes, it's certainly the case that exports are expected to rise at a faster rate here, albeit modestly. But that imports are going to come down is at least in part a story about that export demand looking weaker down the road, because fewer of the inputs being bought means fewer of the outputs will be coming. So, taking all of this together, you get a story that's not necessarily screaming alarm bells, but certainly doesn't scream that there's meaningful improvement here. Where things get scary is when our focus shifts to looking at inflation data, which is actually going to be coming out right alongside this trade report. And here we already see that both the consumer price index and the producer price index, which is wholesale inflation, both of them are in negative territory. So the price of wholesale goods and the price of consumer goods is falling. Not just growing at a slower rate, falling. So here's the zero line right here. Here's where we've been the past several months. Now, looking at the expectations for this, it is expected to get worse on both counts. CPI expected to be down 0.7%. That's worse than the 0.5 in November. PPI expected to be down 3.2%. That's worse than the 3 flat number from the prior month. So all of this seems to speak to deeper deflation. That's really bad news because, of course, why do things go on discount? They're not going on discount because people are rushing to buy them. They are going on discount because they're not rushing to buy them, and prices have to be cut to clear inventories so that somebody comes and buys things. And until inventories get cleared, prices have to continue to get cut. So the message that this sends is seemingly a very negative one, a message that speaks of an absence of demand, both at the wholesale level and at the retail level, which of course speaks to an anemic economy yearning for help. Now, one counter argument to basically say, well, this is not as bad of a issue as it seems, is to look at the internals, and in particular the internals for the consumer. Because at this stage, with external demand waning, it would seem, with the adjustment in supply chains that de-emphasize China after it was in lockdown much longer than its end demand markets in the US and the Eurozone. China lost, give or take, about 3% of global volume of trade in its market share. It had about 15% before COVID. It's down to about 12 now. When you multiply that across total global exports and imports, that is, of course, a vast number. But nevertheless, if we look at the components, and we were hoping that de-emphasizing of China in the global supply chain can be offset with domestic demand, the argument is, well, yes, CPI is falling, but not for bad reasons. It's falling because global food prices are down. So you can see the biggest contributor to CPI going lower here is, in fact, food over the past 3 months. In the yellow is September, red is October, the blue is November. These are the latest numbers here. So you can see food is by far the biggest deflationary impulse. You get a little bit more in transportation and communication, which is, at least in part, it would seem, energy prices declining, a story that we've seen in other geographies as well. And then on the upside, there are some encouraging numbers. For example, entertainment and education is a meaningful increase. And at least on the entertainment side of the story, this is discretionary spending. So it feels like there is perhaps some additional uh, some additional pep here for consumers that isn't being captured elsewhere. Certainly, a little bit of a better view in clothing, and a little bit of a better view perhaps in healthcare, although this is not exactly a discretionary category. But looking at all of this and considering, okay, well, here's the washout between this and arguably this, you get to a negative number, but perhaps not for reasons that necessarily scream consumer demand in China is irrevocably broken. And indeed, if we look at the story for global food prices, the average index there, this is UN data, the average index there in the blue bars heading lower. So we can see here, food prices are in fact inching lower, and with a transmission mechanism from this to global CPI lagging about 7 months, you would expect that eventually this continues to drive Chinese CPI down, and perhaps this is not anything to worry about. Maybe this just improves the lot of consumers, and it isn't necessarily an absence of demand elsewhere. It's an interesting argument, but ultimately, it seems to fall somewhat on deaf ears. Because if we look at the overall economy, we have here the official PMI numbers for manufacturing and the service sector, we can see that China's economy is by no means looking like cheaper food is obfuscating an otherwise healthy consumer and an otherwise healthy growth story. Here's where we are on both of the key sectors. And of course, 50 here is the line in the sand. Below 50 is contraction, above 50 is growth. The further you go above 50, the faster that growth is. The further you go below 50, the faster the contraction. And what you see here is manufacturing is still very much in contraction mode and has been for a while. Meanwhile, services, right after a pop here at the reopening's start, here's that peak in service demand, it has fizzled to next to nothing and is hugging 50 so closely that it's beginning to look like we're essentially at standstill. And that, of course, captures even more acutely in GDP data. It is not a healthy sign for an economy that real GDP data is running north of nominal GDP data. Now, nominal GDP data is, of course, all global, or in this case, all Chinese output altogether. And real GDP data is that total output minus inflation. And what we see here is when we take total output and we subtract inflation, we actually end up with a higher number. Well, that, of course, means that we're subtracting a negative inflation number. And so what we end up with is the economy net of inflation looks stronger than when we put inflation back into the equation. In fact, we can see that there is a gap here of about 1.5, 1.4% in year-on-year GDP growth terms. That is an implied deflationary gap. That isn't just food. That seems to be a much more insidious sort of thing, an absence of demand that is much more economy-wide, much more wider spread. And that, of course, is incredibly dangerous given how important China is to the overall global pie. Now, of course, we know that it's the world's second largest economy after the United States, but when we look at the breakdown, we're talking about 16% of global output. That is, of course, a commanding share. And then we have to consider that in that gray part of the chart, the rest of world 50% that aren't China, the Eurozone, and the US, most of the occupants of that part of this pie are vendors to the other three. That, of course, is no different for China. When we look at economies like Australia, New Zealand, most of the commodity producers in South America, most of Southeast Asia, a lot of these economies are intimately dependent on Chinese demand. So the influence from China's impact on global GDP is actually even greater than 16%. In fact, the influence for all three of them is greater than the 50% they occupy. But that, of course, holds for China. And so if the situation is in fact this dire and the data is going to register broadly in line with expectations as we expect, and it is that dire as a result, well, that's bad news for the global economy as a whole, not just for China. At a time when that global economy is itself seemingly on the ropes. This is global PMI data now for the whole of the pie. And what we see here, again, here's that 50-line center separating expansion and contraction. Very modest pickup here in the global service sector, keeping us afloat overall and inching a touch higher. Manufacturing still very much in contraction mode. That, of course, on the one hand, speaks to weakness in China. They necessarily are a huge part of that manufacturing supply chain, but also leaves very little room for error. If anything in the global economy is going to end up looking particularly weak, there is not very much buffer before that echoes into demand loss and weakness at a broader level, at a global level, including in services, of course. And that suggests that as you get this Chinese economic data and it registers with the results broadly as economists foresee them, we end up having this global recession that we're concerned about looking still more inescapable than it did before the data. And the question, of course, then becomes, well, how much do markets care? At this point, the markets spent next to 2 months, maybe a little bit more, in November and December. Maybe we'll attach the last week of October to that run, depending on asset. Cheering the idea that global central banks led by the Fed will make money cheaper for everyone, and so economic weakness will be easier to swallow because money will be more attainable to borrow to paper over that economic weakness. But at some point, the conversation does have to turn to, well, why is the money going to be cheaper, as we said at the top of the show, and whether the expectations that we have now really account for an economic downturn that seems to be in the offing when we look at this data, when, for example, U.S. benchmark equity indices are hugging not only their swing highs, but in many cases are within a hair of record highs. So where this ends up is as a meaningful risk to risk taking in general, to risk appetite in general, whereby eventually this rate cut story is subsumed, and talk about US CPI tomorrow to get granular on that story. But in the meantime, there is seemingly a potent headwind gathering. This Chinese data might well reinforce its proximity. And at the same time, we look at assets that perhaps don't quite reflect anything but a soft landing and lots of easing all at the same time. One of these is probably incorrect. Either the landing is soft or the easing is ample. And reconciling those things may well look like weaker stocks, may well look like a weaker Australian dollar, may well look like a stronger US dollar and a stronger Japanese yen in the wake of data like this. Now, we may have to wait for US CPI to clear out of the way to see the market moving potential of this narrative, but the fodder to feed it does seem to be on offer as these Chinese numbers come across the wires this week. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, talking about what happened on Wall Street on a given day and what that means going forward. I'm back on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Happy trading out there. See you tomorrow.